we will be monitoring those questions throughout the conduct of today's presentation. If for some reason we're not able to cover all the questions at the end of the webinar, we'll certainly reach out to you after the conclusion to try to get you answers to your questions. For those of you who are CPAs in the audience and want to get continuing professional education credit, please answer the polling questions as they come up, and there will be 4 of them on today's presentation. Most importantly, again, we cover the chat box. We will be referring to our handout. The handout will essentially be the slides that we're going to cover. And if you have any questions related to the handout, let us know. And if you want to take some notes, that's probably not a bad idea. So with that as the tee up, let's kind of begin today's webinar. Good afternoon, everybody. My name is Dacey. On behalf of myself and Peggy Gallagher, we both work in the technical resource group here at Withum, Smith & Brown. We'd like to thank you for taking time out of, I guess, what for most of us is a very snowy day here in at least the New Jersey area. And for those of you who are in different parts of the country, hopefully you're not getting the same level of snow we are. But it's a snowy day outside, but it's a real hot and exciting day inside. So we're real excited to talk to you all and have you spend your lunch hour with us as we go over our CP on an A&A update. This is essentially, I guess, formally the first quarterly update that we're going to be doing. This is going to be a quarterly thing that we do going forward. And if you do have any comments or questions or ideas for future updates that you'd like to learn a little bit more about, we're certainly we certainly want to hear from you and get those ideas. I mentioned the housekeeping points, so I'm not going to go into great detail on this. We mentioned the polling questions. If you want CPE credit, have to get those. We mentioned the handout, which are essentially the slides. Probably a good idea to print that out. If you have a question, use the chat box. We'll be monitoring. And most importantly, for those who are looking for CPE credit, we will send out those certificates probably within about 30 days electronically. So that's where we're at. At this point, I'd like to turn it over to probably one of the brightest technicians I know. She does a great job. She is a past chair of the New Jersey Society Accounting and Auditing Interest Committee. So she lives, breathes, eats, and sleeps this stuff. And Peg, it's a great opportunity to speak with you today. How you doing?
I'm doing great, Dave. Thank you for that very kind introduction, and welcome to our audience. Thank you for sharing your lunch hour with us. And as Dave pointed out, we see this as the inaugural presentation in a quarterly series. And we realize that you can get your accounting updates in many formats and through many providers. So we especially appreciate that you have chosen to do so with Withum today. And we're going to try to strike a very, very practical tone in our presentation, share with you our insights with respect to practical implementation issues that may arise. So here's our general disclaimer. And with that, if you could please advance. Thank you, Dave.
And Peg, I guess maybe one point of interest with respect to the disclaimer. You and I may not even agree with each other on certain things. Hopefully that's not true, but it may happen on occasion. So the important thing here is just awareness for everybody. If you have any questions that come up that you need practical advice, make sure you have the appropriate facts and circumstances and reach out and try to get those answers. So Peg, I'll turn it back to you.
Fair point. Thank you, Dave. And that's a good reminder that since we'll be discussing accounting standards promulgated by the FASB today, it's a good reminder for all of you listening in that if you ever have a sticky situation, it's always good to go back to the authoritative guidance and see what the standard setters have actually written about on the topic. So here is some photographs of Dave and I, and let's turn to today's outline. So here's what we're going to address. We've got 2 big pieces. The first piece is a general FASB activity overview. I'm going to set the stage for you with respect to what the FASB has been promulgating lately, and I'm going to sort those recent standards into a few buckets that I think you'll find very useful. But we're going to spend the most of today's presentation on what Dave and I think of is recent accounting standard updates to care about. And what we mean by that is we have filtered them. We're not going to go through an exhaustive laundry list, if you will, of every single standard that has come out. We're going to filter them and focus on the ones that we think are deserving of your attention. And with that, let's move on. And it's time for our first of 4 polling questions. And I'll turn it over to Dave for the polling question.
Okay, so our first polling question of the day is now officially launched. Which of the following describes your role in the financial reporting arena? And I know election season is over at this juncture, but it is still important to vote, and vote loud, vote often, and get that CPE credit.
Right, so please select one.
And Peggy, the votes are just coming in feverishly at this point. You know, we're almost ready to close this. We do have a fairly ambitious agenda, so if you could wrap up those votes, we will close the poll in 5 seconds, and then we'll see what our turnout is. 4, 3, 2, and 1, and the polls are now officially closed. And we have a lot of industry people, a lot of preparers in the audience today, Peg.
Yeah, and that sounds great. And we have put this presentation together with exactly you in mind. So with that, let's move on. Thanks for your response.
All right, sounds good. Yeah, definitely. All righty.
Okay. So as I said, the first part of our presentation, I'll just give you a snapshot of what has been going on at the FASB. And let's go on to the next slide, please.
All right.
Thank you very much. All right, so pretty boring looking slide, but it's got some good meat behind it here. I always find it useful to present the history of, you know, what FASB has been promulgating in terms of a very simple way of measuring it, the number of standards that have come out. And as you can see, it's kind of been all over the map, but 2016 was a big year, 20 ASUs, and we're off to a pretty vibrant start so far this year. There have been 4 ASUs put forth this year, and there are 4 ASUs that are in the queue right now that, according to the latest FASB agenda, are expected to be issued this quarter. Now, by way of background, obviously, this slide does not capture how many of these ASUs are particularly narrow ones and how many are big, broad ones. And I'm going to be going into that over the next few slides. So if we can advance, please. All right. So let's dig a little deeper and let's think about some of the highlights and themes that have informed FASB's initiatives in terms of ASUs that have come out in the recent past and ASUs that we can expect to be coming down the pike very shortly. And I've listed what some of those big themes are here on this slide. And the first one is a simplification initiative. Now, I know sometimes we don't always associate the word simplification with our standard setters in Norwalk, Connecticut. However, it's true. A few years ago, they did embark on a formal simplification initiative. They heard the feedback loud and clear from users and preparers like the folks on this call, as well as the auditors and the CPA represented by folks such as myself. And they recognized that there were probably some areas of the codification that the complexities embedded in them, they just didn't justify the cost. So they have embarked on this simplification initiative. I'll be touching on several ASUs in the presentation today that came out of that focus. And basically, it represents areas where the FASB issued an ASU to either simplify the accounting in a particular area or to reduce disclosures. So I, for one, welcome that. And you'll see that definitely in today's presentation. And you'll also see that in ASUs that will be coming out in the near future as well. Some broad projects that the FASB has either recently completed or are underway are listed here on this slide. For the most part, most of the FASB's broad projects have been actually completed. The only 2 listed there that are still underway are the financial instruments project and the insurance project. The lease accounting standard came out in early 2016, almost exactly a year ago. That was the culmination of a very, very long project. We actually won't be touching on that lease standard today because there's just so much meat there to go into. So we are planning on discussing that in the future and focusing on the practical implementation issues for you. So stay tuned on that one. The big one with respect to not-for-profit, that standard came out in 2016. It's ASU 2016-14. It had to do with presentation of not-for-profit financial statements, essentially. There is some additional work, mostly in narrow areas related to not-for-profit financial statements and accounting, and that is also ongoing. Lastly, another big driver that has informed the FASB activity is efforts to converge with IFRS. Now, taking a step back, I'm sure many of you remember up until a few years ago, all we were hearing about was convergence with IFRS, convergence with IFRS. We were all waiting on pins and needles for when that was actually going to happen. And you're probably wondering now, gee, I wonder how come I haven't heard anything about convergence recently. And that's because essentially, by virtue of the fact that the United States SEC hasn't officially indicated that there will be a formal cutover date, since everyone was waiting on the SEC to make that announcement and it has not happened, it has essentially, as in terms of a formal drop-dead convergence, been backburnered. And what has been happening instead, as it says on the slide here, is that the FASB and the IASB, the International Accounting Standards Board, have focused on limiting differences between their two major systems of accounting. And so in terms of convergence, you will see that as a driver for some of the standards that we're going to be talking about today. But in terms of an actual official cutover to IFRS, that is not going to be happening in the foreseeable future. So if we can go forward, Dave, thank you. All right. So this and the next two slides are Withum's cut of recent accounting standards that we thought would be useful for you. And so what we have done is we have bucketed the standards in terms of what was required for December 31st, 2016 year end. And as you can see, here are the list of recent ASUs that have come out and that are required by December 31, 2016, since that's a very, very common financial reporting date. Again, the focus here is on private companies, non-public entities, but keep in mind that most public companies, if any of you are working for a public company or in charge of accounting or financial reporting for one of them, most public companies will have the same exact adoption date. In a few instances, they may have had to adopt earlier. So I think it's safe to say that these are all required by December 31st, 2016. I've indicated a few of the ASUs on this slide that we won't be talking about today. And again, that's primarily because it's our sort, if you will, of topics that we feel would be universally relevant to you. We're going to go forward with the ones that I have an asterisk here. So here's your list of standards that are required. And if we can go forward to the next slide, please. And here's another bucket that I want you folks to keep in mind, and that's accounting standards updates that have come out recently that are not in effect, that do not have to be required by December 31st, 2016, but I think they have some attractive features. So I would like you to consider early adopting them. Of course, it all depends upon your particular facts and circumstances, but keep in mind that most accounting standard updates that come out typically can be early adopted. So one of the things that I always do for our clients is I always think about, I wonder if this one represents a benefit that would be advantageous for my client to early adopt. And when you think about the simplification initiative that I spoke about a couple of minutes ago, there certainly will be some of these that I think you will find attractive. So I want you to consider early adopting these. Look for our little icon there, the early bird gets the worm, as we roll through the details on some of the standards we're going to be covering today. And that'll be your visual cue that these were ones that I think you should consider early adopting. And again, in the interest of time, we're not going to be able to discuss all of these today. And lastly, the next slide I have for you, thanks, Dave, are accounting standards updates that have come out. They are not required, and I don't think, for the most part, most people will be interested in early adopting them either. But they are big, potentially impactful accounting standards, so I think we all need to be a little strategic about these. So the first one, Accounting Standard Update 2014-09, that, of course, is the revenue recognition standard. There have been subsequent standards that are listed on this slide that have amended that in a narrow way. Obviously, that's a very large topic, and we could probably spend hours discussing that practical implementation. But those implementation dates for revenue recognition are coming upon us, folks. So I would strongly recommend that you be strategic about this. Think about if these standards are going to be significant for your company. I always recommend do a preliminary sniff test. You know, take a few representative transactions and walk them through the new revenue recognition recipe, for example. Walk them through the new lease standard, if you will, and get an idea of how they are going to impact you, and at least then you can begin planning. So obviously another standard that you should think about in a strategic way is that ASU 2016-02, the lease accounting standard, and then I've listed a few others here on this slide. So just keep these in mind, please. One last question with respect to those strategic ASUs is that don't forget that the users of some of your financial statements may also need to be educated on them as well. So don't forget to build that into your timeline. And it's time for our second polling question. So if we could load that up.
Sorry, Peg, I just unmuted my phone. Okay. Let me see. Second polling question of the day. And we will launch that question. How much of you or your company started preparing for the implementation of the new lease accounting standard?
And please select one response.
Very exciting times. Most of the votes are in, and I think we are going to close the polls in another 5 seconds. So get those final votes in. And the polls are officially closed, and looks like everybody is you know, waiting for this to kind of take on a little bit more of a life, Peg.
Yep, I can understand. It's a lot to bite off. This was the second largest standard in terms of page length that the FASB has ever issued, and it generally won't be effective for a few years. But I would caution you that there are some nuances within this standard. Everyone knows the headline that leases will be brought on the balance sheet, but there are some other nuances that I think are worthy of exploring. But we hope you'll join us in the future. We'll certainly cover this in a future webcast. And with that, let's move on, and I'm going to turn it back over to Dave.
And no doubt, Peg, and thanks very much as we move forward. So as Peggy kind of teed up initially, we broke this presentation up into, and when I say we, Peggy did most of the writing of this, and I have to give her a lot of credit for it. I think she did an outstanding job putting the slide deck together. But in putting this together, we broke it up into buckets, and one of the buckets that we had was recent ASUs to care about. And as you know, as we talk about this, and from a general awareness perspective of what's actually effective, these are things to care about. But by that we mean these are things that are required or subject to be early adopted. But as you're going to quickly see, not all these pronouncements necessarily have the same significance to you. And I think with that as a tee up, let's look at this first slide on simplifying income statement presentation by eliminating the concept of extraordinary items. This slide in and of itself might seem like a contradiction that it's the first slide of the ASUs to care about, but we're going to talk about it nonetheless. From a historical perspective, accounting for extraordinary items was intended to highlight the events or transactions that were unusual or infrequent in nature and are non-recurring. That could be a little bit problematic if you think about it. So, as an example, an earthquake in California might not be considered to be an extraordinary item because earthquakes happen with a lot of frequency in California. An earthquake in New Jersey might be considered to be infrequent, and therefore a loss from an earthquake might be considered an extraordinary item for a company domiciled in New Jersey. So it's a little bit of a mixed bag, and there was some judgment that had to go into this. It is fair to say, from looking at the last bullet, that the concept of extraordinary item presentation didn't happen a heck of a lot in the financial statement world. So what's the message point here? The message point is we don't have to worry about this anymore. The revised guidance removes the concept of extraordinary items from GAAP. And as we drill down on this and look at this a little bit closer, the key to this slide is that unusual or infrequent items are a separate component within continuing operations, and that's kind of the key. In the past, extraordinary items used to be presented directly after discontinued operations in terms of geography within the income statement. The existing requirement to separately present items that are unusual in nature or occur infrequently, that still continues on, but it's within the body of continuing operations, and again, that's been retained. The new guidance also requires similar separate presentation of items that are both unusual and infrequent. The third bullet to me is kind of interesting, and it is definitely a time saver. If you think about it, in the past with extraordinary items, one of the things that we had to do was what was called intra-period tax allocations. So we would do a tax provision with the extraordinary item, a tax provision without the extraordinary item, and then the net effect of that was the tax ramifications of the extraordinary item. Well, the simplification aspect of it is you don't have to do that anymore. So that's a good thing, and I think this definitely has an intended purpose for those rare occasions when you do extraordinary item accounting. It's certainly simplified it to a great detail. Now, as we look at this next slide, and really this slide really covers two accounting standards for the price of one. So if we start with a little bit of history when we talk about debt issuance costs, there were really two concepts when it came to giving something away or incurring expenses as it relates to securing debt. There was something called a debt discount, which essentially was a sweetener, and it was a benefit that was given to the individual making the loan to the company. So, for example, we all learned from our intermediate accounting days in school that debt discounts were essentially give-backs in order to secure debt. If the give-back went to secure debt, that was recorded on the balance sheet as a contra liability. For debt issuance costs, it had the same economic characteristics, except they were costs that were incurred with professionals like a law firm in order to try to draft up a loan agreement and secure debt. From a balance sheet perspective, that was always a non-current asset. Well, what happens with this presentation or with this particular ASU is that now debt issuance costs and debt discount are treated exactly the same way from a balance sheet perspective. They are both shown as contra liabilities. It doesn't change. And before I go on to the next point, there are two exceptions to that. If there is a debt issuance cost that's incurred on a piece of debt that hasn't closed yet, that continues to be recorded as a non-current asset until the debt closes, and then it gets reclassified as a reduction of debt, as a contra liability. The second piece is, and this is the ASU 2015-13 aspect of this, which you can see in the second to last bullet. The SEC indicated that they would not have a problem if debt issuance costs related to a line of credit continued to be shown as a non-current asset and would be amortized ratably over the life of the debt. So, which brings us really to the last noteworthy aspect of this, the fact that it's being amortized ratably over the life of the debt. That is a little bit different than current practice. Now, as we go to this next slide, Peggy was nice enough to put together a really nice example footnote of something from a practical perspective that if you're looking how to present this in your financial statements, this is really one-stop shopping. It's certainly a useful disclosure, and you can see that we have an example loan, and it discloses the treatment of the unamortized costs in a tabular format. It gives some really good detail on the adoption of an accounting principle, that it's being done retroactively or retrospectively. Let's just use those two words interchangeably, and it gives you really all the required disclosure you need. Now, we wanted to give you guys something to do, so the one piece that you might want to just consider if you were going to use this in its entirety is if you have a loan with collateral, make sure that the collateral gets disclosed in the first line item also, so secured by substantially all assets, or whatever the collateral terms are related to that. But notwithstanding that one little change, and it's, again, something to do for you guys, this is a pretty good disclosure that you guys can use going forward.
Hey, Dave,
moving on.
Dave, this is Peg. I just wanted to tell you that we had a question come in on that footnote disclosure.
Oh, okay,
some folks were wondering, some folks were wondering on the balance sheet space, would those unamortized debt issuance costs be netted against the current portion or the long-term portion, or would you prorate it? What's your thought on that?
Yeah, my view is I would prorate it. Now, keep in mind that it may not be material. So if it's not material, the lion's share of the debt discount probably would typically reside in non-current. But I think probably the right thing to do is to prorate it between the current and non-current portion. I mean, do you have a different view, Peg, or what do you think?
Fully agree with you, Dave. Thanks for covering that.
Okay, no, it's a great question from our astute audience as the snow continues to fall here in the New Jersey area. Okay, this next slide, this is very often seen in the world of employee benefit plans. And just as a little plug for Withum, Smith & Brown, we actually audit more New Jersey employee benefit plans than any other firm. So I actually find that to be kind of interesting. So it's a big part of our practice, and it's something that we started to see quite a bit of in our employee benefit plan practice this past season because it could be early adopted. So if you guys are looking for something to do, for the second bullet of this, circle the word practical expedient. Put a big old circle around that, because that's really the cut as it relates to this pronouncement. And what we mean by this is, if you have an investment, if a company has an investment that uses the practical expedient to value the investment. So, for example, the investment would have to have characteristics of an investment company, meaning that all of their assets are being recorded at fair value. They follow investment company disclosure type rules, and if that's the situation, and there's a financial statement for that kind of investment that follows investment company accounting, a practical expedient says you can essentially take the shares that reside for that investment, divide them into the total fair value of the company's underlying investments as a whole, the investments as a whole, and then that amount can be used as a practical expedient for disclosing fair value in the entity's financial statements. So you're going to see this in employee benefit plans quite often in the world of like common collective trusts, pooled separate accounts. You'll see those types of things. It does not apply to level one investments where the investment is based on a quoted market price. But what this pronouncement does is it excludes these kinds of investments from the fair value leveling table. What we normally see in our financial statements is we'll see all of an entity's investments being leveled out, and then for purposes of reconciling to the balance sheet, the investments that are being valued using a practical expedient would just be a reconciling item to tie out to the balance sheet. The thought process behind this ASU was that there was really already robust tabular disclosures for these types of investments. I mean, under a different ASU, I think it's 2011-04, you had unfunded commitments, redemption frequency, redemption notice period. So all that additional information was being required already for investments that use NAV as a practical expedient. So I think the FASB thought this was a little bit of overkill, and they gave a little bit of relief as far as that was concerned. This is a topic that comes into play when valuing inventory at the lower of cost or market. It is definitely simplification. So let's look at a little bit of history, and historically there were three different ways of valuing or arriving at a lower of cost or market valuation for inventory. There was the floor amount, or there was market. Let's start there, which was essentially replacement cost. There was a floor amount, which was net realizable value less the normal profit margin, and then there was a ceiling amount, which was net realizable value. If the replacement cost fell outside the ceiling and the floor, you would default to the floor or the ceiling, depending on which direction it was going. That becomes a little bit of a calculation problem, and it costs money, and it takes time to do those to do that kind of a calculation. So in terms of overall simplification, the policy now with respect to inventory and valuing inventory is to value it at the lower of cost or net realizable value. And net realizable value is defined in the slide in the fourth bullet. So if you have a pen, put a big old asterisk next to the fourth bullet, because that's the way you're going to define what used to be known as market, which is now known as net realizable value. This applies to FIFO, and it applies to average cost inventory. It does not apply to LIFO inventory. So in terms of saving time, if you have this kind of a lengthy evaluation that you're doing in the conduct of your companies, you're better served early, at least considering early adopting this, because it will be a much easier thing to do. Now, this next slide, this really has ramifications for entities that have been involved in business combinations. That's what this is all about. It eliminates the requirement that an acquirer in a business combination retroactively or retrospectively account for measurement period adjustments. So let's say that the company enters into a business combination and they haven't completed all their fair valuations. The valuation isn't done, and you have up until 12 months to get that done, and as long as you disclose it. If you finish up the valuation in the following year, in the past you would have to go recast that valuation with respect to your comparative financial statements. You don't have to do that anymore. So this is really important for an acquirer that's not yet done with their business combination accounting at the end of as of the balance sheet date, and they need additional time. Once those provisional measurements get trued up, they get trued up through the current period, and that's essentially what this is about. At the end of the day, this is certainly a cost saver with preparing financials, because everything's being flowed through the current year. It doesn't change the length of the measurement period. It's still 12 months. That doesn't go away, but it does ease the accounting burden to eliminate having to go back and recast prior financial statements. And pushdown accounting. This is relevant for entities that are consolidated entities, but for one reason or another, one of their subsidiaries needs to have a standalone financial statement. So that's what we're talking about here. We're talking about accounting for a standalone subsidiary when you're presenting financial statements just for that subsidiary. Now, a lot of private companies used to do this. They would just follow the SEC rules, but the SEC concept has now been codified within GAAP. So, under this concept, fair value adjustments, identified intangibles, and goodwill, which were normally recorded in consolidation, can now be pushed down to the subsidiary's financial statements if presenting subsidiary's financial statements. This can be advantageous where a particular financial statement end user needs financial statements for the underlying subsidiary, and that information needs to be reflected. So it's an important thing to think about. One thing to keep in mind, though, there are rare occasions where when there's a business combination, it might result in a bargain purchase gain. To the extent that there's a bargain purchase gain, you're not allowed to put that into the P&L. That would be a capital contribution. So if you have that kind of set of facts and circumstances, just keep that in mind. But this is certainly an attractive alternative. And Peg, I think we're kind of moving along at a pretty good clip. I think it's time for me to turn it back over to you, and let's talk about going concern a little bit.
Thanks, Dave. I just want to underscore an important point that you made with respect to the last slide and the option to apply pushdown accounting. It's an option, folks. It's not required. And if you notice, we put our strategic icon on there because I'd like you to think about if you're in the position of issuing separate financial statements on a subsidiary, this pushdown accounting alternative may be an attractive feature. We have worked with several of our clients on that, and they've been quite pleased with the outcome. So I just wanted to point that out. All right, so I want to spend a few minutes speaking about ASU 2014, which has to do with going concern. I know you're probably wondering, Peg, this standard came out in 2014. What am I doing thinking about this in February of 2017? Well, the short answer is it finally went into effect for years ending after December 15th, 2016, or in plain English, all of you with December 31 year end, this standard is now in effect. And there's a couple big headlines here that I want to share with you. Prior to this ASU, there was absolutely no guidance in the codification on going concern. The only guidance that was out there on that topic resided in the audit literature. So if any of you have ever had to wrestle with this issue before, sometimes things can get a little tense between management and the auditors on this topic. And so the standard setters at the FASB thought that it would be very helpful to establish specific accounting and disclosure requirements with respect to going concern. And building on that theme, this ASU does emphasize, as it says here on the slide, that the going concern assessment is primarily management's responsibility. So I think that should be of interest to many of you who are listening in today. It does establish specific disclosure requirements, and let me take you through some of those details. Let's go to the next slide. All right, so here are some of the details. And again, I just want to emphasize that because this is an accounting standard, this standard obviously applies regardless of the level of service that your outside accountants or your auditors may be rendering on your financial statements. So for example, if your outside accountants are compiling or reviewing your financial statements and they're dated as of December 31st, 2016, well, this ASU applies to you as well. So please keep that in mind. So very quickly going through a few of the details here on this slide, the first two bullet points are some critical definitions, and those are essentially the same as what we had in our extant literature in the audit literature. The third bullet point, the look forward period has been extended, and it's now 12 months from the issuance date of the financial statement. That's one of the headline items here with this ASU, folks. So for example, if you have a set of financial statements and they're as of December 31st, 2016, but let's say that those financial statements aren't issued until April of 2017, the look-forward period with respect to making that going concern assessment would be 12 months from April of 2017. So that would take us, obviously, to April of 2018 in my example fact pattern. So let's go to the next slide.
Hey, Peg, before we move on, one other point that I think we need to make with respect to this. Everybody ought to write down here, as it relates to this slide, the threshold for evaluating going concern is whether you're able to pay your financial obligations as they come due. And that's an aspect of this particular pronouncement that is a little bit different than what we've had in the past. It's a lot more clear. They actually use the terminology, are you able, if it's more likely than not that you're not able to pay your financial statement obligations as they come due, you have substantial doubt. So it's a more likely than not threshold, and it's based on ability to pay your financial statement obligations as they come due. And the reason why I think that's pretty significant to chat about is because in the past, you know, the ability to continue, some entities would say, well, you know, I can string my vendors along a little bit. I can defer paying them, and I can get by for an upcoming year. You don't really have that available to you anymore because of the concept of, if you're not paying your debts as they come due, that's really the benchmark for going concern. So with that, let me just move on. I just thought that was important to bring up.
Thanks, Dave, and that's definitely embedded in management's responsibility for making the going concern assessment. So in the interest of time, I'm going to try to pick up the pace here a little bit. I just wanted to highlight for our listeners some of the disclosure requirements which are established by ASU 2014-15. And essentially, there's two tiers of disclosures. The first one, and number one on your slide, is essentially the same as current practice right now. So what that means when it says when there is substantial doubt, that means, to connect the dots for our listeners, that when there is substantial doubt that the entity will continue as a going concern, so i.e., a going concern will be cited. And so the disclosure requirements associated with that are listed here on this slide. And again, they are establishing these requirements. They were previously best in widespread practice. However, these requirements never existed in the accounting literature before. So that's the first disclosure that's required when the entity, when there is substantial doubt about the entity's ability to continue as a going concern, and again, for that extended look-forward period for 12 months from the issuance dates of the financial statement. Number two on this slide is probably the second headline item here in this standard. And this is a disclosure requirement, and it applies in the following fact pattern. When substantial doubt about the entity's ability to continue as a going concern was initially raised, but subsequently that substantial doubt was mitigated. There is a disclosure requirement now for that particular fact pattern, and those details of that disclosure are listed here on this slide. With respect to current practice, this second disclosure requirement, we did see it from time to time. You might have seen that in a financial statement described as a liquidity footnote. So those are the two disclosure requirements, and if we move on to the next slide, I've included some examples for you. And again, these are just examples of what the disclosure could look like. I hope you find these useful if you should find yourself in these circumstances. So this first one is an example of that number two item on the previous slide. This would apply if substantial doubt was raised, however, it was subsequently alleviated. So this is an example of a footnote disclosure that would be required under this ASU, and I highlighted in bold some of the key language here. So since substantial doubt was ultimately mitigated for this disclosure to kick in, if you notice in bold, it says, this creates uncertainty about the company's ability to continue as a going concern. We're not using those words, substantial doubt. And then if you look a few lines down, I bolded the reduction of the liabilities would alleviate this uncertainty. So this is just an example of that second disclosure requirement. And if we move on to the next slide, the next slide has an example of what we would probably think in terms of today's framework, or the immediately past framework, if you will, of the classic going concern scenario. In other words, substantial doubt about the entity's ability to continue as a going concern was raised and indeed continues to exist. So said another way, in FASB speak, substantial doubt was not alleviated. And again, this is just a particular example. You know, you're probably going to recognize the words that I've bolded here on the slide, which are calling out the fact that there are substantial doubt and that the financial statements don't include any adjustments that might be necessary if the company is unable to continue as a going concern. And next slide, please. I just wanted to queue up for you guys. Some of you may be thinking about, okay, I'm management, I'm responsible for preparing my financial statements. I now have a good working understanding of this going concern standard. What does this mean with respect to my auditor's responsibility? What does this mean with my outside accountant's responsibility if my financials are being compiled and reviewed? Well, essentially, it doesn't really change current practice for audits. And essentially, that holds true for whether those audits are conducted under AICPA standards, which would primarily be for privately owned companies, or whether those audits are conducted under PCAOB standards, i.e. for public companies. There's some additional considerations here because this is an accounting standard, and I said earlier, accounting obviously crosses all levels of service that we, your outside CPAs, can render. So if your financials are being compiled or reviewed, remember they will be held to this standard in terms of that extended look forward period and in terms of the disclosure requirement. So just keep that in mind. This ASU, will articulate in those ways, again, very briefly and at a high level with your outside accountants or outside auditors' responsibilities. And moving on, it is time for our next polling question, so I'm going to turn it back to Dave.
Okay, our next polling question, what are the new requirements if substantial doubt was initially raised but mitigated?
And please select one response. Do you just need to document how it was mitigated? Is it nothing substantially different from the old rules? Do you need to disclose it in a footnote? Or do you need to disclose it in a footnote and your auditors would add an extra paragraph in the audit opinion if you're being audited? And what are
and we are going to close and we're going to close the polls in about another 3, 2, 1, and the polls are now officially closed, and we'll take a look at the results. So it's pretty much a mixed bag. Most people, I think, just said disclose in a footnote.
Right. So technically, if substantial doubt was initially raised but mitigated, that would fall into one of those headline items that I pointed out earlier, which would be a footnote disclosure would be required. So thanks for your participation, and let's continue to roll on here. All right, our next slide is another ASU. Again, I want to point out that this one may be worthy for consideration for early adoption. It's ASU 2015-17. It has to do with the balance sheet classification of deferred taxes. And the headline here for our listeners is that this is a definite simplification. In current GAAP, as you all may recall, if you have deferred tax assets and liabilities under current GAAP, they would have to be separated out between their current and their non-current portion. And what this ASU does, and why I believe it's attractive and you should consider early adopting it, is it does away with that requirement to split deferred taxes between current and non-current assets and liabilities. All the other requirements with respect to deferred taxes are still in place. So keep that in mind. Next slide, please. I just want to bring to your attention another one that I think is worthy of consideration for early adopting. And this one is ASU 2016-09. It has to do with the accounting for stock compensation. It has some particular narrow improvements to the calculation and the accounting for stock compensation. Those details are outlined here on the slide. We have recommended the early adoption of this ASU to many of our clients that do offer stock compensation to their employees. In other words, they offer a stock option plan and most of them have universally found that this has reduced the cost and complexity for them in accounting for stock-based compensation. So I just wanted to bring that to your attention. And in the interest of time, we're going to roll on. So next slide, please. ASU 2016-03. This one came out and addresses the private company alternative accounting standards that were promulgated by the PCC, which stands for the Private Company Council, which is an advisory body to the FASB. So there are 4 of these accounting alternatives out there. They're open only to private companies. A good example that many of our listeners are probably familiar with is the option to amortize goodwill for a private company in lieu of the mandated annual impairment testing. So when these private company alternative accounting standards came out, there was some confusion in practice with respect to, if I did not adopt them on or about the same time that this alternative accounting standard for private companies came out, have I missed the boat? And what this ASU does is it essentially says, no, you have not. So the takeaway for our listeners here is that if you haven't adopted any of those 4 private company alternative accounting standards, you still may. And so that's what this ASU did. And if we'll roll on to the next slide, please.
Just wrapping this up, the clarification of the definition of a business. This is really relevant to business combination accounting, and whether you have a business combination or an asset purchase. Under business combination accounting, an acquisition is not a business unless it has inputs and processes to create outputs. So what this pronouncement does is, and specifically if you look at the 3rd bullet of this slide, if substantially the fair value of all the gross assets acquired are concentrated in a single identifiable asset or a group of similar assets, the set is not considered to be a business. Why does that matter? Well, because in an asset acquisition, acquisition costs are capitalized, but in a business acquisition costs are expensed. In-process R&D is capitalized in a business combination, but it's expensed in an asset acquisition. And if you had any kind of contingent consideration, that would have to be measured and valued as of the acquisition date if you had a business combination, but it's recorded as a contingency, and it doesn't get recorded until the contingency is resolved if it were an asset acquisition. So that's just a real quick tee-up of that pronouncement. And then just moving on as far as the on horizon, just keep in mind that we do have some other programs scheduled for future webinars. Our first program is on February 15th. We have a risk assessment CPE. President Trump's policies on how they affect your portfolio. That's a February 21st webinar. And as you can see from a CFO accounting update, we have quarterly updates scheduled for each of those dates that are out there. Stay tuned. There will be invites sent out. If you have any questions about this, reach out to our marketing folks, and they would be more than happy to help set you up with this. And with that said, we've got one more polling question. So let's roll that out. And if we could, go through that quickly, that would be great.
All right. And which of the following is not true regarding ASU 2017-01? And if you recall, that was the final standard we just discussed. Please select one answer. And in the interest of time, we're going to close the poll in 5 seconds. 5, 4, 3, 2, 1. Thank you very much for your responses. And
those polls are closed.
And I can see that the preponderance selected D, which is one of the big takeaways here, that if the requirements or the screen, as it's referred to in the accounting standard 2017-01, are met, the acquisition would not be scoped into business combination accounting. In other words, it's not a business. So this is one that I personally, although I am an accounting geek, am very excited by. And I know in our practice, we are seeing and hearing a lot about business combinations. And I know this ASU is one that I'm always bringing up, because if you can be scoped out a business combination, that's going to reduce the cost and complexity in the accounting for it for you. So that ends our polling questions, and that ends our webcast for today. I want to thank everybody for tuning in. We hope you found this useful, and we look forward to having you join us with those upcoming webcasts. Any final words, Dave?
No, I think you covered it quite well, Peggy. Have a great day, everybody, and if you do have those questions, feel free to get back to either Peg or myself at our email addresses. We'd certainly love to help you guys. Have a great day and enjoy the rest of this snowy day. Take care, guys.